Hello everyone, welcome to Option Gig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. Today we're going to talk about how to put bullish or bearish trades using call and put options. This will help the traders who are just moving from stock to option trading, and they are either bullish on a stock or they are bearish on a stock or ETF, but are still trying to figure out how do I use calls and puts to express the bullish or a bearish sentiment. So today we're going to cover expressing bullish trades with calls and puts and also the bearish trade with calls and puts. Bullish means you want the share price to go up. If you are bullish on a share, it means you are thinking that the share price is going to go up. If you're a bearish on a share, it means you think that the stock price is going to go down. In the purely stock world, if you're bullish, you will go and buy the stock because the stock will go up and you will sell it and make the profit. If you're bearish about a stock, you will go and sell the stock. But in an option world, there are literally more options, pun intended. Using calls and puts, you can express your bullish and bearish sentiments on a stock in multiple ways. So let's see, how do we express or put up a bullish trade? There are two ways. One is you could either buy the calls or you could sell a put. Remember, buying call means you are getting an option to get the shares at a determined price, which is strike price. Why would you do that? You would do that if you are bullish on a particular stock, so that you give yourself an optionality to get the stock from someone and you will sell it in the market. That's why buying call is a bullish strategy. On the other hand, selling put means you are giving someone else a right to sell the stocks to you or to put the stock to you. So it means if you are selling a put, you're collecting a premium and your hope is that the contract will expire worthless, the stock will go high, and no one in its right mind will be giving the stock to you at a lower strike price than what it is currently in the market. So selling a put is also a bullish strategy. So let's compare the two strategies that we looked at for being bullish on a stock. One is buying call, the another one is selling put. So in buying calls, initially you spend money to buy the call. Maximum loss is limited to the initial amount of money that you spend. That is your initial cash outgo. The theoretical profit potential is unlimited. And that is why this strategy entices a lot of newbie traders, because they think that they can buy a cheap calls and then expect stock to go much higher, and hence resulting in multiples of profits on their initial investment. And this is available for most levels, almost the entry level of traders. If you go and open an account with a brokerage firm, they will allow you to do buying of calls. Let's look at the other side, which is a selling put. In the selling put strategy, you collect money when you initially sell a put. Theoretical loss is total value of stock. Why? Because let's say the stock goes lower than your strike price, the stock will be put to you. And if the stock becomes zero, then that's your complete loss. Again, I should emphasize that it is a theoretical loss. The actual or the real scenario may be different. The profit potential, the maximum profit potential is limited to the initial premium collected. So when you sold a put, you got an initial premium from a put buyer, and that is the maximum profit potential. But remember, this is not available for all levels of traders. Just because the theoretical loss value could be higher, it is only available for a certain level of traders. Now let's look at the other one, which is how to do bearish trades. Again, there are two ways to do the bearish trades. One is to sell the call. That means allowing someone else an option call the shares from you. And to sell, when you sell this call, you collect an initial premium. And since you are a bearish on the stock, you think that the stock will go down and be lower than your strike price, no one in its right mind will be exercising that contract at a higher strike price if the stock is available in the market at a lower price. So that contract will be out of the money, and hence you will retain all the premium. So if you are bearish on a stock, you will sell the call, or the other thing is you will buy the put. So buying put is also a bearish strategy. It is because since you are bearish, you think that over next 1 month the stock will go down, and to protect yourself you will go and buy a put and get yourself a right to put the stock to someone else at a current market price. Selling calls and buying puts, both are bearish trades. Again, when you buy the put, you spend initial money to buy the put. So that is an insurance premium kind of a thing. And the loss is limited to the initial cash outgo. We have seen even same is the case with the calls. Theoretical profit potential is 100% of the stock price. Let's say if you hold a stock in your portfolio and if you buy a put, the stock could go down to zero. But since you bought a put, you had that insurance which will reimburse you for your stock, for the loss in your stock. Again, this is available for most level of traders across all the brokerages. On the other hand, on the selling calls, you're collecting a money when you initially sell a call contract. Theoretical maximum loss is unlimited because the stock potentially could go to infinite price. And if that ever happens, the person who has bought a call would call the shares from you. You'll have to give the shares to that person at a strike price, but you'll have to buy those shares from the market at infinite price. So your theoretical maximum loss is unlimited. Profit potential is limited to the initial premium that you collected when you sold a call. And again, this is not available for all levels of traders in all the brokerage firms. So you should check with your brokerage firm. It is available to you at your level of options trading. Takeaways. Whether we decide to buy or sell the options, it depends on the risk profile. If you have capacity to take some risk and be rewarded, option selling may work out for you. Second thing is whether the option prices are high or low. That also may determine whether you want to sell the options now or whether you want to buy the options now. If the current option pricing is historically low, you might be better off in buying an option in some cases, so that if later on the option prices go higher because the volatility has gone higher, you could sell it. And lastly, the amount of buying power which is available. So anyway, I think it is very important to keep these trade-offs in mind, because once you understand how the option pricing are determined, what's the current option pricing, is it too high, too low, what's your own risk profile, how much buying power do you have available in your account. Once you understand these things and then make a conscious decision of whether you should be buying an option or you should be selling an option for either bearish or bullish, does not matter, but you're making a judgmental decision on buying versus selling, I think that will separate the winners from the rest of the pack. I hope you found this useful. Thank you very much for your time. And if you have any comments or questions, please write it in the comment section or email it to optiongig@gmail.com. If you find it useful and you liked what you learned, please help us spread the word so that other people can also benefit from it. Thank you very much.